Yeah, my name is Ruizhe Jia. As Jeff says, I'm an assistant professor at Stanford MSE. So today's topic is, which Jeff probably forgot, which the price of participation. So participating what? I'm pretty sure all of you here have voluntary and involuntary, implicitly, explicitly participate in financial market, no matter it's from retirement fund, your personal investment and everything. But it's still very unclear how does that complex system really works? What is the price you're paying for just access to the market, get the thing you want? And this is a co-author work with my excellent student Xin Meng. She's a third-year PhD at ICME at the Applied Math Department, and she actually does majority of the work here, and she's amazing. And then also Xiao and Samak from Columbia Business School, and they're amazing co-authors, which will not have this paper will not happen with all of them. So that's kind of the stone. We're going to understand what's the price of participation, and we're going to leverage the microstructure of perpetual future market in on blockchain actually. So before I dive into what exactly is the price participation, I want to give you some headlines. So you should know that we're talking about it's not just pennies cost that the society doesn't care. If you just look at the Bloomberg's news, Jane Street made $40 billion last year, and I heard this first quarter they made $20 billion. And if you put on scale, the most kind of innovative form in the barrier Anthropics valuation is 800 billions. So you should know that in this opaque, huge, complex market where you also participate, there are people lose all their net worth. There are people join together, make one Anthropic in few years. So that's the scale we're talking about. And you want to understand how this market works and how do we make it better? How does make sure society's um, resource is allocated to the right place? So as the academic, we really, really want to understand who is participating in the market and what drives people to transact. And especially for normal people, how does it really cost? And is that cost fair or is something wrong's going on, right? So to understand all those questions, we need to not only have empirical work, theoretical work, but we need to have a huge transparency anatomy of the whole market. So that's kind of what we're trying to do here. Um, so the question is, we academic have learned that for the past 45, 50 years in a subject called market microstructure, which is to study how trading in the market works. Many of you may not be in this community, but what we're really trying to say is from theoretical perspective, why people trade, and from empirical perspective, we measure that. But pretty much a lot of time we eventually focus on one thing, which is, oh, when you and me want to do transactions, especially retail, what we do is we're actually paying a spread, which is when they do a transaction, we don't actually trade at the mid price, and then we're paying some small spread to get access to what we call liquidity. And that seems to be what we're really paying for, at least at normal retail users. But is that really the case? It's like, do you ever face something like, oh, I buy the stock. Why after I buy, the price just seems to goes down? Isn't that supposed to be random? As the academic tell me, it's a random walk, right? So the classical theory try to understand this very complex system from different angles. For instance, adverse selection, just gave you example, right? There are people who would call informed, who knows, like the sharp people who know where the price of the market's going to go to. And us, we're called uninformed. We just try to put some meta stock on our retirement account. But the market maker cannot differentiate who is who, so they have to protect themselves. That's why they may charge a spread to protect themselves from information. So that's what kind of classical theory like. They charge a spread because of some market frictions. The market friction can be information, can be they don't want to hold too much inventory, can be that sometimes it's hard for find people who are trading against, can be that people are trading too aggressive that they don't know what to do. It can be predatory behavior that your people know you're trading, they want to front run you and so on, right? That's kind of like you can see classically, people try to understand this very complex system from all kind of angles. And each of them make some sense. But it's just so hard to understand what's really going on. Why is it so hard? Because eventually it's an empirical question. No matter how much we understand theory, we don't know what is true, what is wrong until we look at the data. So traditionally, all you see from data is pretty much in the market. You see there's a transaction, a trade happens at a timestamp, and you don't know who is doing that. You don't know who is on the other side of the market. You don't know the history. But that's kind of the information you're getting. Similarly, you see the orders in exchanges. Someone say, I'm happy to provide some liquidity to the world for this size. Again, you don't know who is who. You don't know what's going on there. It's just so hard to understand the system when everything is simply pulling together. But we, on blockchain, I don't know, it's luckily or unluckily, we can pretty much see everything, right? So you actually, on this exchange called Hyperliquid, which is a perpetual future exchange, and they are actually on a blockchain, you can actually see who is doing what kind of transaction, his whole history. Are they getting liquidated? And what kind of order they're submitting? Where they're submitting the order from? Are they like Robinhood trader just clicked on some front end? Or they're doing something very, very special here that I'll tell you more of that. Something immediate or cancel, which called IOC, which is either I want to snipe some order or gone. So like, and then more importantly, how can we utilize this all those information to understand some, I would say, law of physics in the financial market and and to tell people what's really going on in the financial market. So that's what's going on, right? Traditionally, it's just so hard to understand what's really going on in such a complex system. We have all this data, but they're somehow aggregated together. You only see some piece of that. But on a blockchain, what do you do is when you trade digital asset, when you're on a public blockchain, you can get from the person's identity, the order type, what's happening on the limit order book, the price they're doing, what the position they're holding when they make this marginal trade. After trade, what happens? Are they getting liquidated? So we know the full picture. And this we're going to try to do here. We want to use the data set to understand who is trading, why they're trading, what's the cost of trading, and how should we improve this whole financial market. So pretty much that's what you see. You see everyone's transaction from whose wallet, what kind of order, and what price they're filling, what the liquidity structure like, and the position of the users. So to give an overview of this whole paper, what we're trying to do here is we want to leverage this data we have. We want to give you, at least in the perpetual future market, give you anatomy of the financial market, and hopefully that extrapolate to many other markets. But that's all we got. And I want to tell you from this data, who is participating in this market, who is financing all those market activities, and through what kind of economic channel, what is the economic behind that. So what I'm going to show you is how my excellent co-authors together just use this data to segregate who is the people who are market maker, who are people like us, retail trader, who are those sharp people who are taking the liquidity but in the informed way, and what is the price they're paying to the market, who is interacting with who. And more importantly, we want to think about what's the cost of a normal person participating in such a market. We'll see that fee is large, that's something explicit, but the deeper is the economics. You realize people like us, we are really, really uncareful about the order we're choosing and when do we make those transactions. And because of that, we're paying because we demand for immediacy or liquidity in those really bad states. I'll tell what those bad states are. And what happens is those are very, very predictable. And the whole market participant just trade against us. And that's how the wealth is transferred. And that's how the each penny is being transferred and made for someone else. So that's the overview of the market. I'm going to tell you who is parties in the market, how they're interacting with each other, how money get transferred, and we're going to be like a detective to understand the economic mechanism behind it. So that's the paper. Question?
I have a question. I guess How do you determine who is informed and who is uninformed? Is that
This,
known in advance or is it something that you observe?
that's a good question. What do you think of someone is informed? Like, just it's interactive. Just think about example. Who is someone informed? Think about it.
Semi-informed?
Like, who is informed? And just maybe think about that. And give me example. Uh,
Well, yeah, I mean, you could have like an extreme example of insider trading where
mhm.
there's strong asymmetric knowledge,
Yes.
but you could also have, I don't know, like
But
if,
that's a good example. Then
Mhm.
say you have information about there's a war, and after you buy it, what's going to happen?
Mm.
The price can go up, right? So
Sure,
if your
yes,
trade always align with what's going to happen in the future,
gotcha.
that means you're informed. So
Yeah,
that's kind of how we, so like that's what I like. In the talk, I like to let people to think from first principle and then we answer a question.
yes,
Okay,
yeah,
great. So that's eventually how we solve it. Like you see, if some category of people, they always trade in the right direction, and that typically means they're very informed.
gotcha.
Yeah.
So it is something that you observe.
Yes.
Okay.
Okay, so it's very messy, right? Even though you have the full data set, like you don't know who is who. You can see there are people never trade with front end. They never click on the website. Front end means like they come on the website and trade. They submit something called add liquidity only, which means that they provide liquidity in the market and they always put in and cancel, put in and cancel. There are people submit majority of orders just clicking on the website and they're only active 1 hour a day. So the first thing to do is just look at the data and figure out who's who. So that's the first thing we do. And then really like you just want to see some pattern, right? Like those people, they trade every 1 millisecond. There's no way, and they always add liquidity to the market. They're active 21 hours a day. And there's no way they're it just with or at least with class we define them as market maker who provide liquidity. And there are people who just click and trade, and on their front end, and they don't trade much. And they're kind of like more aligned what we think is non-algorithm, more retail-like behaviors. And there are people who don't clicking, but they also don't add liquidity, and they use API to do transactions. So the first thing is like my co-author and I first figure out from the data, like who's from like first principle and definition of what we mean by market maker retail, who is who. That's the first thing we do. The first behavior type is we call them market maker, and they're indeed market making in the sense of they always add code almost 24 hours to this book. And they, whenever something changes, they cancel and repost. So they pretty much put code there, cancel, put code and cancel. Always make sure they are providing liquidity at timely price. They never send transactions through the front end. They cancel almost all their orders because information change in the market. So it's really like if someone is just always go there, there's first behavior is someone just go out there all days trying to provide liquidity at the we call in the very high frequency and to show the liquidity to the market. And that's kind of what we end up classify as market makers. And second thing, right? Like we have this precious data, which is what we can identify who is just clicking on a website, like me clicking on my slide right now to send orders and take some liquidities. And those people actually don't trade very often. When they feel we want to trade, they trade. They just don't trade much. And then they submit majority of orders through this website. So that's the second type. Like, well, they just casually trade, click some buttons, and that's kind of like what we think's retail or front end trader may be more precise. And the last thing is algorithm traders. They don't use the front end very much. They use API to send transaction to take the liquidity in the book in the sense of they're trying to trade with the market makers. And maybe we think they definitely trade with a reason, right? What they're trading, we figured out more. But we classify those people who don't try to add liquidity to the market. They're not market making. They're also not like clicking button on the website. They just an API and taking. taking liquidity from market. We call them algorithm traders. So those are three things we classify. There are more people we classify, but eventually those three are the things we're going to cover the most. The first group is called market makers. They mostly post liquidity. There are not many of them, but they take majority of the volume for a single ticker. And then the second thing is called front end. They pretty much trade by clicking their buttons. And then there are a lot of them, and they also majority of the volume. And the rest of them is called um, bot. Their algorithm, they trade with high frequency, but they don't make the market. They're taking liquidity off the exchange for some reason with a bot. So that's the first thing we do. We label those users from those anonymous address and by their behaviors. And one thing is like this, once you label them, you can think it's a Markov chain, which sometimes they change their label. A market maker can suddenly become algorithm trader and so on, right? Like that means your label is unstable. But we realize like 97.5% of the time, those labels never flipped. So they have these persistent patterns in the market. So question so far? Any question? So, okay, so that's the first thing we do, right? Then you can study what's really happened there. So the first thing you can do is you can just figure out if, just as Lisa mentioned, if you think every trade you're trading at a price and then you maybe close your position 2 hours later, or you think the 2 hours later is a in statistics what we call unbiased estimation of the fair price or expected return, then you realize there's a huge transfer of wealth, which is the retail on a single ticker within a few months lose almost $50 million. And then that's only on one exchange and just one ticker. It's not even the biggest ticker. Whereas market maker and algorithm trader keep making money. So that's the first takeaway you have. The wealth get transferred from those people using front end clicking to the algorithm and market makers. So, okay, so that's the first thing, right? But how do we study that? When money get transferred, we think someone make a trade. You have a trade price and you have how price is evolved. We typically separate into two things, which is first thing is called timing. And that's what Lisa talked about information in the sense of if I make a trade, price always, if I buy it, price always goes up. Means like either I say I'm informed or I have good timing, right? After I trade, price always move in my favor. So I'm kind of have information. And it's just hard to imagine someone have negative timing, right? Because if you flip a coin, then like you shouldn't like do buy and sell randomly. You shouldn't have like negative timing, but we're gonna have some very surprising results. Some people actually have negative timings. So that's the first thing, right? We should, whenever you look at a trade, there are some things you pay for execution, which is that's the current mid price. But typically, when you do a transaction, your price is worse than mid price. So you lost that forever just by execution. But the second thing is timing. Like when you buy something, the market can move in your favor, can also move against you. And that's the two type of losses, right? You can think one is, are you really have information? Second thing is how much you're paying for execution, right?
Hey, can I ask a question?
Please.
So I'm curious, on the previous slide, you said that was for just one asset, right?
Yeah.
So I'm wondering what happened to the underlying asset? Because, for example, let's say that like the asset appreciated in value over that time period, then you would expect the market maker to make money. But then if on assets that go down, the market maker loses money because of their inventory, like then like maybe it's fair, right?
So it's really about um, this, right? Think about when you make a trade and then you kind of pocket something from the spread as market maker, right?
Mhm.
And then say in average, if your trading horizon says 2 hours, you're holding inventory, then that part capture like how much you lose from the price movement, right? So, but
Right.
the deeper reason is really like um, when you make a trade, you can imagine there is an observable fair price. So you think about like there is expectation of the price and there's how much you really pay, but you don't observe that from the market. And typically what you assume is like the future price after long enough, all the information get embedded into the price plus some noise is an unbiased estimation of like the expected price. So kind of like if you aggregate enough trade in the group, you hope there's some law of large number to tell you, oh, that's the expectancy per trade a person loss. So there is some like a deeper reason why people use this measure. Yeah.
Right, but I mean, like, why should we believe that that's independent of the movement of the underlying asset? You see, so I'm not like this methodology seems to make sense, but what I wonder is like if it also depends on the asset, like maybe it behaves very
Mhm.
differently for different kinds of assets,
So
or like assets that undergo different things, like in an asset that like on the previous slide, that one asset, what actually happened to the underlying price? Like, was it steady or did it go up or down over that time period?
yeah, so typically, so there are things um, connected to that. So from my experience, it matters in the sense of like, is that a mean reversion asset or like, so like there are some depend, but normally it doesn't matter that much. So pretty much like if you most of asset, if you're a professional, you can see your data professionally in the sense of like you can realize you realize loss kind of converge really nice with this result. And also typically like you can think the market like people normally when people trade buy or sell, it's kind of random a lot of time. So, but there definitely has some kind of if the asset is always like people buy, that there's a lot of momentum that like the market maker gonna have you will see that this a little bit different in the sense of they always maybe in some horizons suffer some loss. So eventually this definitely relate to the horizon thing relate to like how the asset the lot of feature of asset works. Like do they have momentum like or there are stable coins and so on. But typically I think is a relative good measure for most of the asset. Yeah, but I think like deeper, you realize more in the future slides that it definitely has something into like how the asset works and people's behavior around the asset. But typically, like you can think in the very, very micro perspective is like most of things is random. The best people who can predict 2 hour returns, like maybe the best hedge fund in the world, like if 5 bips out of maybe say 2% volatility. So it's a very, very random thing. Yeah.
I was just going to throw in, so market makers, you're a market maker, the market's going down,
Mhm.
you have inventory. Well, you kind of know that you might end up having typically positive inventory, especially the market's going a lot. So you hedge it out. If I have X inventory, if I'm holding X inventory on average long, I can
Mhm.
hedge that out, and so I can just keep concentrating on the spread. When things become more volatile, I increase the spread. Increase my ask price and decrease my bid prices. So market makers can still make maybe as much money almost when the market goes down as when it goes up.
Yeah, I think this is two-sided. I think because hedging is, I mean, this is kind of like, I believe for a lot of market, when hedging is very cheaply, for example, SP 500 options and so on, then for some market, I think it's really hedging is kind of costly. I mean, just like discussed, it still becomes market maker either like to hold inventory for some time, hopefully eventually the inventory bounce back. So that's kind of a lot them what they do in practice. Also, what happens is you realize that this leads to some really bad things when they hold inventory and price always move against them, and they can also force to get rid of the inventory. So like I think ideal versus if hedging is costless, that's kind of the best. When hedging is not costless, you can see people who deal with inventory better and people who don't deal with inventory better, and there are going to be some behavior very interesting you're going to see later. So yeah. But normally, like if you're trading something like SP 500 option and so on, then typically it's very, very likely you hedge it. And so also the second thing, right? Execution is also related to your size in the sense of if you are familiar with order book, is you people are happy to some size at 100 0.1, some at 100 0.2. So if you're trade a lot, you're gonna trade some sides here, some sides here, and some sides here. So the execution cost is a function of your size. And the half spread is kind of the beta spread the market shows for certain quantities, but then there's also slippage when you have a bigger size. So the transaction costs eventually also have to be pretty much break down into those things, right? If someone's paying a lot of like execution costs, you should ask like, are they paying a lot because they have a huge size, or like when they're trading, like even the first level price is pretty bad, or like so what's going on there? So eventually, both for execution and timing, we have to look very carefully what's going on there. Um, so. But when you look at things very carefully, you realize it's not only about spread. So what happens is, if we don't look at liquidation, which is when everyone knows it's bad, when you have to force to sell something at a very bad price, it's there is something obvious, right? Like you pay fees. When you do transaction, you pay fees. So that's some very visible fees we do. And it's also clear we people do pay execution. We're not careful about that. I think to me, at least, when I look at this, the whole result, um, even all three of them or all four of them will give a lot of insight. It's kind of surprised to me you can do worse than a coin flip a lot of time. So when you make a transaction, the mid price can kind of after the trade happens, it doesn't happen to all tickers, but can move against you. So because the worst you can do to me is you do a coin flip, but that's kind of the surprising point, and will actually illustrate why that happens. So. Okay, so question here before we go into each of the bucket one by one to talk about the economics there. So the first thing is fees, right? People don't run exchange for charity. And you realize that the retail people, even those are like 50% of volume, they pay 83% of the fees. And market maker is majority of the volume, they pay only 5% of the fees. So kind of the first thing that tax the retail is they pay a lot of fees per trade at 3 bips. So you can really think who is kind of paying for the exchange. It's mostly the retail people. And also there is one thing is fees are typically related to how much you trade. So they kind of want you to trade more. And also do you stake? So they're kind of like related to Jeff's work and so on about governance. Like people have tokenomics around that. People who are in the platform can stake their token to get lower price. So this is not what I study a lot, but typically you can see people who stake a lot, who are very fee sensitive, are those market makers or algorithm traders. So there's a very interesting question, right? Like, even though fee is just so obvious from the market structure perspective, but it's actually lead to a lot of governance and tokenomic questions. Like people who are finance, it's like a big casino. People who are financing the whole exchanges are the people who are retail and so on. And then you have this fee pool, and this is the fee will go back to buy their own token, but then market maker can stake this token to get fee discount. It seems to me like the market maker become the dealer in the casino, and casino have this token. The whole thing, only people who are financing everything is the retail. So there is a lot of incentives going around there, and there's always this does this tokenomic make sense, right? Shouldn't they be compensated for the whole thing? And how you should govern that because those people are going to vote, right? On a lot of the parameter and so on. And people who are really financing everything is the retail or front users. But that's not kind of what I study. But I just want to bring that into people's thing about if you look at exchange like Binance or Hyperliquid, there is such a thing where the tokenomics hinge on they're paid by those people, but they're more incentive aligned with the market maker who are dealing the card to the retailers. So yeah. Okay, so fees is the obvious cost, but execution is not, right? We want to understand like, do they pay execution cost from like this the spread is just more expensive? When they make trade, like market maker kind of just know that and then they widen the bid spread. We're like they just have they trade too much. The quantity is so large, so they have terrible slippage. Whereas like even something in between, right? So like we realize that the story is much more um, kind of nuanced than you think. The first thing is half spread is kind of the same across all groups. So like when people trade the first level, they pay the same cost pretty much. So the half spread doesn't explain what's going on there. And then you should know that trade size does matters. When you make the trade size larger and larger, when you have fixed liquidity, you're going to have to pay higher slippage. So indeed, retail trader, if you look at their distribution, they're really like heavy tail around large orders. So you can think about size actually explain a lot of the heterogeneity of the slippage. But again, that's actually the case, right? If you look at this graph, which is half spread, if you look cumulatively, the retailers lose a lot of money from that. But if you see the per trade in bips, actually all three groups are the same. And the difference really is at the slippage, where the retail slippage is just much worse compared to algo and much worse compared to the market makers. So that's where the things really is. And but then I think I explained like large trade have bigger slippage when you cross multiple orders. But the thing is, even with control for size, there are still residual remains. So you can imagine in the paper actually run some regression, and then let's visualize what really and there's also puzzles, right? So you realize like if retail is trading large size, shouldn't they clear the first level more often? But you realize like market makers seems to clear this first level of order more often. So they are the people kind of take the whole liquidity in the first level much more often. So like there's some like puzzle effect here, right? Retail is trading a lot of large size. They're paying a lot from slippage, but the market makers who actually cross the first level more often. So what's really happening here? So you really, oh, but then eventually realize what happens is market maker only trade when the liquidity, the first level has a lot more liquidity. So it's a select when there is liquidity on the book. So they're much more kind of professional when they trade. And more importantly, do you know who they're trading against? Why suddenly there are so many liquidity on the order? We actually do analysis, you realize they're trading against the stale order of the retail people. They just leave order there and the price become not fair anymore and people just snipe them. But then I want to show you the full picture. The first you can see this is um, the how big the size is of the trade. And those are three different buckets: retail, market maker, and algorithm trader. You can realize that for small trade, the slippage doesn't differ that much. Most of the difference come from the big trade. So when you have a bigger trade, market maker and algorithm trader do it much more effectively. So that's actually explain what's going on. And secondly, you can see more clearly when market maker do a big trade and the y-axis is actually liquidity on the book, they're selecting when the liquidity is much thicker. And those liquidity, so the y-axis is the liquidity on the first level, and then the x-axis is the size of the trade. You can see the retail trader, they don't care. Whenever they trade, the kind of the liquidity is the same. But those two professional traders, they only trade large size when there is sufficient liquidities. So most of the difference happening actually here. And you also see, so there are two things, right? Distribution wise, market maker trade a lot of, most of trade is like middle size, and algorithm trade a lot of small size, and retail trader trade a lot of big size. So that explains most of our retail traders trade are in this region, so they pay more slippage. But even more is what happens is after you account for that, there are still difference. And where the difference come from is actually the gap here, which is when they submit a large order, the liquidity is different. And that's why when conditional on this submit the big orders, the execution of market makers is way better. So the interaction effect of the size and then the execution also matters. So to put it in the whole story, right? Retail pay much worse executions. It's not because the half spread is bad. There are two reasons. The first one is they typically trade very large size. But the second reason is kind of subtler, which is they don't really select when there is good liquidity in the market. They just trade. Whereas the rest of the people select when there is good liquidity. And more importantly, it's not here, but if you look at data very carefully, you realize that what happens is the liquidity when the market maker trade big orders, like 30% actually come from the retail. So they just leave a limit order there and until someone hit it. So they are the people kind of make the other people's trade cheaper. So that's kind of the full story of the execution. And now we're going to the more interesting part, right? So that's kind of the timing. Timing is very interesting in the sense of timing measures when you make a trade, maybe say like 1 minute later or 5 minutes later, how the price evolve in the 2 hours, right? So like you can imagine like if the normally people think is a random walk, the market is. So if you think about you do a coin flip, in average, your mid price kind of stay the same, right? So and then it's just hard to do worse than a coin flip if you kind of randomize. But there are some people just whenever they make a trade, they kind of the the price just move against them. So that just exactly happened to the retail people. What happens is if you print out the how retail's horizon of the cumulative, you can think this is from 5 minutes to 120 minutes. It's like if this goes down, it means the price is moving against them. So it means like if you measure retail exit their position at 5 minutes, they only lose this much money. But if they wait for 2 hours, like the market always move against them. Uh, and then what happens is, sorry. Um, so the thing is, that's very, very counterintuitive, right? Most people should like algorithm trader in the sense of after they trade for 5 minutes to 120 minutes, it should be kind of flat. Like it doesn't make sense after someone trade from 120 minutes. They're just the price just move against them. Unless they are very predictable, people intentionally make that happens. So that's kind of to me is like in the whole literature, we think they are just noise trader. They make a trade, pay a spread, and the market move whatever way it is. And but in fact, they're doing worse than coin flip. And that's something really surprising to us. And then so the headline here is retail kind of lose 22 bips when the market starts evolving. And then so what's really going on? So in microstructure, we have this stats tool called structure VAR, which is really trying to measure like if I have a like price change, do we see retail trading? And when retail trade, does people background them? Do people front run them? What's really going on there? So there are three things you see, right? First is retail trade is kind of very auto-correlated. You realize that when there's a retail trade, more people just coming and they just cluster together. So there's some elasticity going on. Second thing is retail chasing the price directions. When price goes up, they tend to buy more. When price goes down, they tend to sell more. And more importantly, you do see that after they trade, the professional try to take the opposite directions. They're back running them. So they know what's going on and they start to lean against them within 10, 15 minutes. So that kind of explains why after they trade, like someone kind of counteracting them and price getting worse and worse, and so on. So this is something, right? Like persistence is they can see, like for market maker when they take, the direction is kind of like random. But for retail, it kind of tend to cluster together. That's the intuition here. And that makes them more predictable. And second thing is they tend to trace where the price is going, right? When price goes up, the retail people, the red one, tend to trade in the same direction, where you can see market maker tend to trade against the flow. And the last thing is after retail trade, so imagine there's retail trade, and the positive means that the red means like more retail trade after them. You can think when retail trade, there are more retail trade until sometime it decay that they're no longer like more autocorrelated. But you can see after retail trade, those market maker, the blue two chart, are market made algorithm. They're just starting to trade against them. They're trying to feed the flows because they know it's going to come into an end. So the first takeaway here is why does retail lose from timing? Because they're so predictable. And then people can background them and they themselves cluster together. But if the story end up here, I mean, it's fun, but I wouldn't be that surprising. But then what's really interesting is after you consider a state, which is when someone do a trade, do they already hold position on that? You can open a contract, which is you don't have the thing, you start trade that thing. And you can close when you're earning money. So you can choose to close your position when you earn money, and then you can choose to close a position when you're losing money. But you can imagine when you're close to choosing position, you are losing money, a lot of time is because you are forced to do so, right? And then after we see that is, you can imagine we're still looking at from 5 minutes to 120 minutes. So you can realize what happens is the only type of trade that lose money or move against them from 5 minutes to 120 minutes is when you're close a order and when you're losing money. And you can see the three lines, they're a little bit different, front end market and algorithm. They're not that different. So it's not really the identity itself explaining what's going on. It's really retail is doing more of closing where they're losing. So you can think, why do people close when they're losing? It's kind of like only if they're forced to do so a lot of time, right? So like, and everyone so when you're choose to open, you can do the worst you can do is do a coin flip, and you should be fine. And when you choose to close, typically you close, you can choose to close, then you can close. The worst you can do is again a coin flip, and you can close at the price in favor to you. But then only if you close when you're losing. A lot of time you're forced to close your position. That's when you are most predictable. And that's why regardless of who you are, you lose a lot of money. So it's really not who you are. It's really the law of trading here is retail are doing much more of those trades. They are forced to close very often, and those are predictable, and those are background. So if you look at what's going on here is if you enter here and then if you are levered or something, and then you have no choice of, and people just close here, they're autocorrelate, you can imagine, and you have to close at the most painful place and price start to rebound. I think that happens to most people in their life. Like the stock market just keep dropping, I sell the thing I bought, and they start to revert. So what really happens is if you still do the statistical analysis, you look at structure var, it's only if there is a return shock, price move in one direction. That leads to, regardless of who you are, that leads to a lot of close losing flows. So when have a shock of the price, and people start to close losing. And then when there is a lot of retail close losing, there are people get background. And eventually our the market makers start to take the opposite directions. And that's exactly what lead to this bad timing. So, I mean, this just gave us a man map of how at least future crypto market works, right? Maybe not all market is really you can think it's like mini squids, right? Like people hold different positions, and then you force them to close their position at large scale when at the most painful time, and you buy back their position, price start to move. And that's where a lot of the things going on in the market that we don't really observe a lot. And that's what leads to those bad timings. So, I mean, like there, I don't want to go into more detail of this, but you see all the time, like when retail is opening, closing, and so on, um, people start to, especially market makers, start to trade against them, and then to get their positions. So like it just always, and the market makers flow is really just predict more about the returns, where retail's open pretty much just flat. And so we don't claim that there is like causality in terms of like their predatory behavior that something going on, but it's kind of like still to me is when I was in trading, a lot of things we predict is when people are going to close their contract, when they're going to have flows. But the flow prediction, if I trade before flow, isn't that what we're doing? We're trying to predict what's going to happen and put position before them and background them after that, right? So I think even though there is not very explicit predator behavior, but that's kind of like how the market works. You have a mini squeeze, people, you know it's going to happen, and you lean against them, and then so they have to force close their position and so on. So eventually, like what we have here is right, we have the fees, retail pay for the protocol and everything. We have the execution, retail pay the market maker, and we also have this timing, and they pay for people who are backgrounding them, counteracting them. We also have liquidation. I don't probably don't have time to go over everything here because I thought my time is 30 minutes. But you realize that like liquidation is the worst scenario of an involuntary close, and that's get transferred so much more money. So in the sense of you can imagine that in one single day, there are $400 million of liquidation volume, and there is so much money getting transferred in one day just because in cryptocurrency is so volatile and retails are sometimes leveraged. So eventually, what contribute is really we help people to better understand how the market really works. So in the sense of there are so many classic theory, you don't know what exact, but after that you can explain partially, but you still don't have anatomy of who is trading, why they're trading, why the money get transferred, and what is the cost of participate, at least in this market, and where the people try to identify what's going on and also provide economic intuition or mechanism, what's really going on there. How do you explain those surprising results where retail just lose money from timing and what is the economic behind it? So that's kind of what we're doing in this paper. Um, so the takeaway is really like spread is just one thing. You don't only pay spread when you participate in the market. It's really a chain of things you pay as a normal person in the market. And then timing is not about who you are. It's not about which direction you're a trade. It's about are you have kind of predictable behavior and do you have a forced behavior that you must do? And the transparency doesn't get rid of the things we doesn't falsify any classical theory have, like liquidation, inverse selection, predatory, but it gives us more transparency of what's going on and help us measure what's going on. So that's kind of what I want to talk about this in today's talk, and happy to have any question. So this is we're still haven't released the first draft, so that's the first time I'm actually telling people the full result. Yeah.
So cool. We have some questions. I saw David raise his hand earlier, so let's start with you, and then we also have Henry.
Um, yeah, thanks. This is super interesting. I guess I have like kind of several questions. I mean, one, there's like you're talking about liquidation, but I think there may be sort of like soft liquidation and hard liquidation. Like there's people who trade on margin, and they get a margin call or whatever.
Mhm.
Or there's some smart contract that liquidates them, or they just have like some psychological pain threshold or something where they don't really have to liquidate, but they can't take it anymore.
Yeah.
Um, so I guess what I'm curious is like if you could like design a trade mechanism and like kind of give advice to retail traders, like, you should always put like this kind of order in. Like, is there something that like we could do better, whether it's supported or not? And kind of things that the reason like this might be the case, like I don't know if this is useful or not, but like when I trade stocks on Interactive Brokers, there's this thing called an adaptive order. And if you put even a market order in, it could like take like 20 minutes to execute. So I don't know if that's like doing any better or if 20 minutes is too short to make a difference. Or if you can decide randomly ahead of time like that you're going to trade one particular day the next month and like you don't disclose that, but then like you hold yourself to that no matter what the market is doing, so then at least you'll get the random, as opposed to like if your psychology is making you get like worse than
Yeah.
random.
I think you have a lot of points, right? In the sense of first, we should have regulation of leverage trading, right? Because forced close a lot of time is because of leverage. And that's when the whole world has a lot of leverage, you can see a lot of cascading. And that's why liquidation even worse than those mini freeze is like when everyone is first to liquidating, then they're potentially cascading. So the first thing I would say is like don't give people leverage, but people love leverage. They love gambling. Second thing is the second thing you can try to save is like execution or timing, right? Execution, I think there are many ways you can solve it. I think US equity market execution is not a thing anymore. You just need to submit. I mean, unless you have so much money, your order doesn't matter. So you just small orders like 50 order, like just one lot, you'll be fine. And you split order around the world, around the time. For timing, I think it's just really about like, as you said, like if you don't take leverage, they can now force close you. But there's also psychological part, like, but that only happens because you're trading, you're not investing. Like, as you can see, like if you don't have edge of collecting the spread, if you don't have edge of collecting the timing, you shouldn't even in the market in the first place. So I would be like, people shouldn't be trading. They should just investing and they
Oh,
execute.
but wait, but hold on. Even if people are investing, if it turns out that like they're always getting in like 2% worse or whatever, like
Mhm.
that's bad because that's gonna be like
Yeah, so that's
so
execution, right? Execution, you'll be fine unless you're like you have for SP 500, like you can trade like a million a minute easily without impact the market a little bit, right? So
well,
like
but
you
I thought you were saying that like if I trade then like I would have been better off trading 2 hours later or something, like for most people.
But that's because the trading 2 hours later effect only happens is when you're forced to close, right?
I
So
see.
so like that's
I see. So
because
you're only looking at sales. This doesn't apply to purchases. I thought you were saying just in general, any
close
trade.
can be
But
buy and when you're short, when you close, you buy
yeah, oh
back.
sure, sure. But
When
you
you're
said I see.
so it doesn't matter your direction. It matters like you don't want to put yourself in the position that you are forced to.
So are you saying that for opening positions, people tend to be random and it's just on close that they're losing?
Yeah, when you're forced to do
I
something, you
see.
are pretty.
Got it. Okay.
Yeah, yeah. But
Okay.
save the execution and then don't gamble. That's
Yeah, so
the
that's not so bad. If you basically say like if the advice you give people is don't take leverage and then like this goes away, the fair unfairness goes away, that's okay. Like that's one way to solve it.
don't be predictable. Yeah.
Yeah.
Okay, two more questions. I think we
Yeah,
have.
let's jump to Henry.
Yeah.
Thanks for that. This was a great presentation. Really enjoyed going through it. I'm in the prediction market space, and so famously, liquidity is a key issue across a lot of these markets because in many ways there's so many. I know so much of this is talking about timing. I kind of wonder, like, do these dynamics, this is kind of hyperliquid adjacent now the HIP 4 is going to roll out prediction markets, right? Um, how do you think this dynamic kind of plays across prediction markets where there's arguably, somewhat more of an intrinsic value to the asset at a given point in time in terms of the truthiness of it, if you want to call it that,
Yeah,
right? Like,
so actually have
have you
a
looked into these
yeah.
dynamics?
We have a work on prediction market. So it really depends on what you're predicting. If you're predicting Bitcoin 5 minutes up and down, it's not very useful to the whole world. And then also like you see a lot of manipulation flow. So you only see, so I kind of don't have time to show you the graph, but you see they start to manipulate the market and stuff like they try to express their view. And then think about some other things, then you have to balance the informed flow and then uninformed flow. And then how do you kind of like people can free write information, right? Like if you have good information, people can free write. How do you like trade off like information and liquidity? So there's always trade-off here, right? If information can get a lot from like trading information, then someone has to pay for that. And then do you mutualize that good enough? And prediction market is very hard because market maker in perpetual future market is like different tickers. We can scale very quickly. But then prediction market is like everything is a separate risk. We have to price the risk very differently. We can discuss more, but it really depends on the type of thing you're trading and then what you're really trying to achieve and how you kind of mutualize information and liquidity. Jeff, last question. Uh, you're muted.
It's 1 o'clock, so I'm going to pass because I have my question. I'll talk to you separately
Okay.
on Sunday.
Yeah. See you.
Okay, thank you so much, everyone. This
Thank
was
you.
great. We will follow up, but another great session. Thank you so much.
Okay. Bye-bye.
Thank you.
Take care.
Yep.